So for my agents, let's talk about temporary interest rate buydowns and how it can be beneficial for both sides of the transaction. So we know everyone hates interest rates. That's a common thing, that if those were lotto numbers, we'd all be winning at this point. So while we can't change interest rates can be extremely expensive to buy down and everyone is holding their breath for refinances, there are options out there with temporary interest rate buydowns. So temporary interest rate buydowns come in two forms. There are seller paid buydowns and lender paid buydowns. For the seller paid buydowns, those can come anywhere from a 1-year reduction all the way to a 3-year reduction. And the amount of seller credit that is needed will change based on the loan amount and the interest rate that's locked in, because essentially what that seller credit is the amount of savings per month for the term of that temporary buydown. The total of that is the seller credit that's needed. So if they're saving $300 a month for 2 years, that's the amount of seller credit that's needed. We do have a worksheet that we plug in with the specific loan amount and the interest rate that we have estimated to give you guys at least the minimum seller credit that is needed. So those temporary interest rate buydowns can come in multiple forms, from as little as a 1-year buydown all the way to a 3-2-1 buydown. So for example, for a 3-2-1 buydown, let's say the buyer decided to lock in at a 7% interest rate. For their first year, they're paying as if they had a 4% rate. Second year is a 5% rate. Third year is a 6% rate. Last year after that, as everything goes back to normal, if they don't refinance, is that 7% interest rate. However, that requires the most seller credit. So typically what we see is a 2-1 buydown. So again, if they're at a 7, they're paying a 5% for year 1, 6% for year 2, 7% for year 3. Those are your seller paid buydowns. There's also lender paid buydowns. For example, we have a 1-0 lender paid buydown. And what that means is that the lender and the buyer are splitting the cost of that temporary interest rate buydown. So the rate may be slightly more expensive than the non-buydown rate, but we're covering the majority of that cost, and they get a 1 point lower. So if they locked in at a 7, they get a 6% interest rate. The whole point of these is to, 1, help reduce their costs temporarily, and 2, really to hold them over until it's time to refinance, when hopefully they're in one of these rates anyway. So this can be super advantageous for your buyer, because a lot of these temporary rate buydowns, they're saving $300 or more per month for at least a year, if not longer. So it really helps reduce some of that payment anxiety. Now, you may be saying to yourself, well, why would the seller want to do this? That sounds horrible, right? So it is a negotiation tool, though, because we know, again, sellers are worried about what? Proceeds, and 2, days on market. So if you've had a home that's been on the market a long time already and you know you're going to ask for seller credits, it may be worthwhile to talk to me as the lender first and see how much you may need for that temporary rate buydown. I cannot guarantee you every lender is going to offer it, though. We do. So these are specifically if we have buyers and sellers together. So it's a good idea to see what that credit might need to be and how much your buyer has in closing costs. If they can cover their own closing costs, 9 times out of 10, they want the temporary interest rate buydown. Again, they can save $300+ a month sometimes. That's what's most important to them. For the seller, asking for those credits and receiving them may be what helps get it under contract faster, especially if you can advertise it out on the MLS that the seller's offering a credit that can go towards interest rate reduction. So that's a good way to hopefully incentivize more buyers. The other option is when you're negotiating that, just like any other seller credit. Let's say you need $5,000 for that interest rate reduction program. Property is listed at $500,000. You were originally going to come in at $490,000. Maybe now you can offer $495,000 and ask for the $5,000. We're talking about, a $25, $30 change to that person's mortgage. They're not going to feel that, and it's probably going to be worthwhile to you to win that offer and get them that temporary rate buydown. So we've definitely seen the use of temporary interest rate buydowns significantly more over this last year as rates continue to be unfavorable. So if you have a seller and you're wondering again how to incentivize buyers to come to your listing, offering a temporary interest rate buydown, knowing that they have to offer that seller credit, could definitely be worth it. And again, maybe you negotiate that through the price. Same thing on the buyer's side. If you're hoping to get more buyers in and you're trying to keep those contracts under contract, asking for that seller credit and checking with us on how much that needs to be can definitely take some anxiety off of your buyers. The good news is too, they can still refinance anywhere in between. Let's say they're only a year into that 2-year temporary interest rate buydown, they can go ahead and refinance if rates drop. That way they get that nice lower rate going forward. If you have any questions, let me know.